My name is Ben Marshall. I, along with Al Mendelson, Oski Hedvad, and Moshe Weinrib, make up the Chestnut River Business House. Tonight, I'm going to be doing the opening and closing act of our presentation. Al Mendelson is going to come in right in the midsection. He's going to give us the structure of a K1 form. He's going to go through the mechanics of the K1. And then Moshe is going to do the main walkthrough. He's going to go through timelines of the taxes. He's going to go through delays, depreciation, state filings, and reporting requirements. So I hope all in all that that we'll get through the big areas. There are obviously, when it comes to taxes, a lot of little things that we need to be talking about. We are not here as accountants because none of us are accountants. We're real estate developers, and we know our side of the sheet. So that's what we're going to do. So let's get started without further ado. All right. Good evening, everyone, and welcome to tonight's Real Estate Shark Tank. This section is on demystifying investor taxes and K1s. We know tax season can be intimidating, especially when you're dealing with K1s, multi-state filings, and depreciation schedules. Our goal tonight is to simplify all of it, make it clear, actionable, and give you the right context to talk to your CPA. This matters for 4 big reasons. Number 1, it simplifies your tax prep. Number 2, it helps avoid IRS mistakes. Number 3, it gives you a clearer view of your investments. And number 4, it saves time for you and your CPA. Most importantly, it helps you approach real estate investing as a long-term tax optimized strategy, not just a cash flow play. The tax goal. Our job is to help you maximize after-tax returns. And to do that, you need to understand the timing of the income and the distributions, and how that affects your liquidity and personal planning. If you've ever asked, why am I getting a K1 with a loss, but also received cash? This session is for you. Our role versus your tax advisor, right here, this is a key point. We are real estate operators. We design efficient structures and provide the necessary documentation, but we are not your tax advisors. Your CPA knows your unique situation, and they need to be part of this conversation early, especially if you invest in multiple states or across various vehicles. This presentation is guidance, not advice. Always consult your advisor before making decisions. With that foundation in place, I'll hand this over to Al Mendelson to walk us through how our deals are structured and what that actually means for the K1 you receive.
Good evening, everybody. I'm Al. So has everyone received a K1 before? Can I just have a show of people present? Has everybody seen a K1 document? Just so that I have a show of hands. Okay. So 1, 2, okay. The K1 tax form is used to report your earnings, your losses, and your dividends by making a statement of your private investment. It's a federal form. Very important to understand. The information on the form must be sent to the IRS as it pertains to your federal tax filing. The pass-through entity tracks your stake in the earnings and sends you the form by March 15th, which sometimes gets a little confusing because you may need an extension. The schedule for the K1 can be found on the IRS website. It's also known as the Form 1065 for those looking for more detail on it. The K1 is not an explicit vote, okay? Let's be clear on that. There's nothing that is required to be done with it. It is to be used as a document by your professional accountant to help guide you with your taxes. It's not a voucher. It is not a form of income, okay? The 1099 is an IRS form used to track dividends, interest, capital gains, and losses, and other form miscellaneous incomes. So what's really important to understand is when you look at what we earn as income, it's important to understand that for us as real estate developers, we're offering passive income. Passive income gives you the opportunity to be offset against the K1. So let me divest for a moment here into understanding what the income structures are that we typically will find in a business today. You'll find active income, which is your ordinary income or Social Security. Secondly, you'll find portfolio income, which is royalties, interest, dividends, and so forth from shares or long-term gains. And then you have passive income, which is from rent or business involved in the real estate field as ours. It's in those last 2 categories where we get the advantage of getting the K1 to be deducted. So people get very confused, and I want to I don't have slides prepared, and I'm happy to speak to people individually afterwards. Again, I'm going to state I'm not a CPA, but I've been doing this for 40 years, so I understand the K1 intimately. It's very important to understand what this document shows you your portion of the activity which you're due based on the rental income or loss in the transaction, as an example that Ben and I might invite you into.
Hey, Al,
You
would it be useful for us to put a K1 up?
you can if you wish. We could. I didn't have control on the slides. If
Yeah,
you
we
want
have
to
it
do
right here.
that, it may be. The problem is you really need to do an actual and you need to be able to fill in the numbers. So let me get down here to the net short-term capital gain loss, net short-term capital. So let me just give me a second to see how I can best use that document. And yeah, this is going to be hard to do then. It just, I think it's more important to explain what we do with the K1 and how it conceptually helps guide. So many folks who've received a K1 are going to find that their original offer of money invested in a transaction will show up, let's use a round number of $100,000. And then right below it, you'll see that for some reason it shows that you have a loss of $105,000, which I'm just going to use as a theoretical number. And people say, oh my gosh, I've lost my $100,000. I'm negative $105,000. Well, this is very important because this is where the advantage of being in real estate becomes so evident, because this is where the tax deductions come in, cost segregation, tax deductions taken from depreciation, and so forth. And those are added up into the second area where you then show a loss. When you deduct your original investment and from the overall activity of the entity, you find that you have a loss number in this example of $5,000. That negative $5,000 is what you're going to carry as passive income losses and you're going to carry over to your tax documents for your CPA to then file against your taxes. So, not to dig too deep into the concept of the K1, but stay with the concept that it is a critical document to be used in your filing. The K1 is one that offers you a material way to get your taxes reduced. I think that's the best way to describe it. So, as we've been asked to speak on the understanding of the K1, it could become a very lengthy conversation. So, I'm going to keep it fairly simple. What does one expect as a limited partner investor? Well, the documentation of the K1 is always going to be filled out by the sponsors. It's always going to be given to you. Don't fill anything out. You just use that as a document, which you then set off and give to your CPA to file. So let's just talk for a moment about different identities of people that can use the K1 in different ways. And it's very important to understand that the K1 is not something that can be used as an offset against active income. Why is that? Many people ask, why can it not be used? Well, it's meant to be used against passive income, or you need to show that you're what is considered by the US tax law, by definition, a reps. The real estate professional tax professional is something you have to qualify with under two tests. One is that you have to show you have more than 50% involvement in a full-time trade or business during the tax year in real estate, property, trades, or businesses in which the individual is receiving material benefits from the business, but it's tied to real estate, like a broker, as an example. Then you have the second test, which allows you to be qualified as a rep and use this against all income. And that is a 750-hour test. The individual must be expected to perform more than. It gets a little complicated when you start looking into this. If anybody wants to read up on this, look up under the IRS publication 925. It has a very clear explanation of how to understand this. Always recommend you consult with a specialized CPA to get the total application against your personal taxes. So, therefore, if you show that you are under the U.S. federal income tax purposes that you are defined as a reps, you can use it against all income, active income as well. If not, you can only use it against the passive and the portfolio income, depending how it's applied. Well, Brian, do you have a question? No. Okay. So that is just a brief introduction into the concept of the K1. I think at that point, I'm going to hand it over to Moshe, and then I'm going to answer more specific questions as they come at the end of the discussion.
Thank you, Al, for running through that. One important point, which I think you did mention, but I want to make sure for the LPs listening, just in case you tuned in to the active real estate aspect, is that usually as an LP or someone with a W-2 in a different industry, any loss that you can bring from your K-1 onto your personal tax return can only be used to offset losses from other passive income. Al, as you were mentioning, if you want
Yep.
to use these losses from passive income, such as, let's
Correct.
say, a loss from, a stock investment or other types of activities. Now, going into some of the timelines of K1s, there's a lot of negative association with and maybe sometimes consternation between sponsors giving out K1s and people receiving K1s and questions as to the timing of things. We try to work as hard as we can to, yes, thank you. I need to move my slides, but we try to work as hard as we can to get our K1s from our end to you as investors before your April 15th deadline, which means that we have our own deadlines that we need to keep in mind. And there's a lot of work that goes into meeting those deadlines as soon as the year closes. So even though it's, 3 months, 2.5 months before our March deadline to get out RK1s for you to hit your April deadline, there's still a lot of things that take place. So just to walk you through some of the different components of what happens in this slide. So at the end of the year, end of December, beginning of January, the previous books are closed and we start going through the numbers, reconciling everything, making sure that all the accounts are correct and up to date. We work with our CPA to review, do a third party review with them, and then to apply any depreciation to the different projects that we have ongoing. And by the time we get to March 15th is when our initial delivery deadline is. Now, many times, and especially if a firm has been operating for a long time, they can have very complicated end of the year transactions. The books may not be as simple to reconcile, especially when you consider rents coming in or projects finishing. You can have situations where you close a deal at the end of the year in order to fully apply tax benefits of cost segregation and depreciation. Those studies can take a while to close and complete. So let's say we buy a property that is stabilized and is renting in November or December. We want to order a cost segregation to depreciate that asset in a most favorable and advantaged way for our investors. That study takes time, and if we can't hit our March deadline, we'll file an extension for our K1 reporting, which means that it's very likely that the K1s won't come out before your April 15th deadline, which is not the end of the world. It just means that you'll need to file an extension as well. But in the name of trying to provide you the greatest benefit, that is the most advantageous thing for you to do. So, several reasons why they're late. Again, it's not due to us kind of just sitting and waiting and hoping that we don't have to fill out the taxes, even though they need to get done. We're very much actively working on them, as you can see from us bringing up this discussion as early as December, because it takes time. It's on our minds, and we want to make sure that these do get out as early as we can. Other things that should be considered, which we didn't mention before, is most of our projects right now are physically located in Massachusetts. We have investors from around the country who are invested in these projects, and there are different tax rules for investors that come from out of state. There are withholdings that might need to be done if there is income that comes in. So again, there are things that complicate the process of simply figuring out how much income came to each project. And again, we consult with a CPA and we run our K1s by them before, but just to have you understand what the process looks like from our end and how it plays out between the end of the year and when you receive the K1s is super important. Our philosophy with reporting and communication is that we do try to communicate as regularly as we can, and that certainly makes no difference to how we distribute the K1s, how we distribute our distributions, and any sort of major event and update. As always, everyone is welcome to reach out and ask questions. There is definitely a lot going on here at Chestnut River, so if you want to hear from us more often, feel free to give me a ping at any time. But communication is key. With that, I am going to turn off my mic and hand it back to Ben.
Thanks, Moshe. Let's close with what you can expect. First off, thoughtful structuring using standard CPA-friendly formats. Secondly, clear communication, even on complex topics. We're not going to hide complexity with you. We address difficult conversations directly, and any changes are explained clearly, detailing their impact. Lastly, clean reporting, reviewed by independent CPAs. Our third-party CPAs prepare our K1s. They're thoroughly reviewed. The goal is to minimize your tax burden. And what we ask from you is simple. Keep your info current, review your K1 promptly, reach out early if you have any questions. This partnership works best when it's two ways.
All
Very
right, Ben,
important
thank
that
you very much. That is the main portion of the presentation. We wanted to keep it light because there really is a lot to jump into here. Things get very complex and complicated. Rules change as you talk about different types of investments, different types of vehicles. And so the idea of this presentation is to be introductory and the start of a continuing conversation. If anyone has any questions about specifics, we'll try to answer them now or refer you to our CPA. So I'm going to open up the floor. Al, again, thank you very much for.
Can I just add one more thing? I think it's important for everybody to recognize this. One thing that may not have come clear is that if you get confused about the concept of passive income versus active income, ordinary income, and so forth, and people say, well, I've got mostly ordinary income, and that's why I'm investing, and we don't have enough income initially to take advantage of the K1. The K1 doesn't falter because you don't file it and use it immediately. It's a carry forward. So if you don't use it in year one and the property appreciates and you get more profits and cash flow, I think it's very important to understand that part of the K1 is that even though you get a depreciation advantage and a tax advantage, it has nothing to do with not receiving your cash flow, number one. And number two is if you don't use all of the loss on your K1, it's a carry forward the balance and you can use it in future years.
That's a great point. I can say personally, I was running my own business and taking my primary income as ordinary income and not as a real estate professional for many years. And over that whole time, I was building up a massive account in my carry forward. And then when I went off to start being a full-time real estate professional, I didn't have to pay taxes for many years. It was quite nice.
Yeah. Very important piece.
So if anyone has any questions, this is the great time. Otherwise, we can wrap it up. We have a lot of tax preparation ahead of us in the next 3 or 4 weeks. That's basically the only conversation on our minds at the moment. But there's a lot to speak about. There's a lot of opportunities and a lot of different tax strategies that we didn't go into just to keep our conversation simpler. And we may do further webinars on those specific things, such as opportunity zone funds and segregate, like we were talking about cost seg studies, those sorts of strategies that we use on a lot of our projects.
I would just say it inures to your benefit. It speaks to the quality of the type of deals that you put together and the way that you operate, that you would actually think to put a webinar like this together just to educate your investors on an obligation that you have and how you handle it. It's not really my space because I'm a debt guy, but we do issue those to our investors too. So I appreciate getting a little tickler about it and very glad to see how you guys operate. And I'm going to pop off, but I wish you the best. Stay in touch. And thank you very much for good, informative.
All right. Thanks for joining us, Brian.
Brian,
Thank you all, I should say.
Hi, hello. Actually, I have a question. Can you guys hear me?
Absolutely.
So I have a question about the 1099. So as LP, so we will receive only K1 or both K1 and the 1099?
So, Al, do you want to address this?
I need the question to be repeated. I'm sorry.
So the question is, does one receive a 1099 and a K1 as an LP, or does one only receive a 1099 or only a K1?
No, the two things are different. The 1099 is a different document. The losses does not offset W-2 or 1099 or contractor income unless you're qualified under the reps.
Right. So to further answer that question, a 1099 is a form you receive showing that you received income, ordinary income, as if you were working as an independent contractor for somebody. Whereas a K1 is for passive income. It's where you're making an investment and you're either taking gains or losses on paper. So it's two separate parts of it. Often people will pay their employees as 1099 sort of incorrectly in order to minimize their tax reporting requirements over the course of the year. It changes everything. So it forces someone to be an independent contractor, but it's a different form altogether.
I think maybe another or interesting point is that you'll receive a lot of K1s. Let's say you have a savings account that pays interest. They'll actually give you a K1 as well. So you're getting K1s from your banks if you have any investment funds. So the K1s that we're giving you operate in a similar way. It's an investment, and the K1 shows you what the income was, what the profit loss was from that investment. And you then take that information and apply it to your personal tax return. So, and like any other investment that's flowing to your tax return, that's the same idea here with the K1s that we're distributing.
So for unfinished projects, so we will still receive K1.
For projects that are ongoing, it's important that you get K1s as well,
Okay.
because it's very possible that there is a loss reported as far as the IRS is concerned. Let's say money was placed into use in the project, or, on paper rent was received. That's important that you get that information at the end of every year, because the IRS wants to know what profit and loss you got, even though you still own the property. So an ongoing investment will receive a K1. With the projects that we have currently, to make this more practical, we don't have any profits yet because they're all in some form of construction and we haven't put them on the market or started renting anything out. So there isn't any income to show. And this year, we may not have any losses to report either, but the IRS will understand from your K1 what the value that you have in each project is. So we take each project, we allocate the portion of each project to each investor based on the monies that they invested. And that's what is called their basis in the project. So even if there's no profit or loss, it's important that your basis in the project is reported in the correct year, so that when there is income, when there is profit, when there is any sort of loss that we can create through tax strategies, that gets applied to the basis that you had in the project.
Yeah.
So this year, you'll see that money was contributed to a project, but you likely won't see any income or loss, depending on how things shake down. Each project is different. Rentals are different than condos. So it's possible that Harvard Ave will actually be able to show some sort of paper loss, where we started that conversation with our CPA earlier this week. We were hoping to have him on the call, but he was not able to make it tonight. But it's very possible that there might just be more than a capital contribution for the 71 Harvard Ave project for this year. Does that answer the question?
Yes. So after the project finish, when we receive revenue, do we have 1099 or we still only have K1 to file?
Yep. For a passive investment, when you're putting money in and you're not working at it at the job, then you're only going to get a K1. It's because your money is doing the work and you're not physically working. When
Okay.
you're physically working at something and going to an office, you're doing that. That's when you'll get the 1099.
Okay.
Awesome. Thank you, Luke. Any other questions?
I think just the other comment to respond to the gentleman's question is just that when you're reporting a K1 during a construction process, there's usually a significantly imbalanced loss statement that's going to be offered to the investor, and then it would be offered on your investment share of the entity. If you were to get even more technical about it, for you to get the K1, the entity has to be set up as a pass-through entity, which ours are. It's very important to understand that. So as a general statement, it doesn't necessarily have to happen, but it does happen if you have a pass-through entity, such as a partnership or a LLC that you set up correctly, which we always do, so that all partners get the benefit of the investment, both income and loss at all times.
Thank you, Al. Yeah, I just threw that up just so that you can connect the
very
visual
important
to
how our deals are
what you were
structured.
saying.
Yeah.
But there are, even when we have an LLC set up, there are different ways that we can elect tax treatment. And there are different types of corporations that either the corporation can get taxed and then income is passed through to the owners afterwards. What's known as a partnership is essentially a pass-through tax entity. So the corporation which owns the projects don't pay taxes, but the monies are flowed through to each of the owners. And then based on each owner's or each partner's tax situation, the money that they receive is taxed accordingly. So and again, it should be noted that whatever we're doing for any one of our projects is not necessarily the best way for someone else to be doing it for their projects. Anytime you set up a new project, it's prudent to talk to a CPA and someone who understands tax law so that you are setting up your corporate structure in the most ideal way. But for most of the projects that we are doing, we set up the holding companies that hold each of the projects that we're doing as pass-through entities.
If I may add, the important part to understand about the K-through is that it does both capital contributions and distributions of the partner. It's an important point to understand. And in really getting into the weeds here, there obviously wouldn't be distributions during construction. So it's really all about capital contributions, and capital contributions then will divvy up your share of losses, which is the other technical point about the K1 I think is important to understand.
Yeah, there's definitely a lot here. Thank you, Al. I think we'll probably do another one of these webinars as it gets closer to filing, where we can go through some of the more nuanced specifics. There's a lot of really interesting laws in place depending on whether your project is condo based or rental, and we'll want to go through those more as we get closer. But again, if there are no other questions, I really want to thank everyone for joining tonight. This has been a great start to kicking off tax season. Al, it's been a pleasure having you on. We'd love to get you on these more often, but we really appreciate seeing you here tonight. And as always, Ben, thank you for your fearless leadership and pushing me to get these going. For all of us celebrating Hanukkah, happy Hanukkah and a happy New Year too, because we are probably not going to do another one of these before the end of the year, as we are getting close to the end of December. So again, everyone, thank you for taking the time. If you're watching this online, please smash that subscribe button. No, I'm just kidding. It's been good to see you. Thank you, and have a wonderful night.